Across Asian markets, supply chains are fracturing under the weight of deep economic volatility. Export-reliant nations are scrambling to maintain their commercial footing as established global trade routes break down. The primary catalyst for this friction is the Trump administration's sweeping tariff agenda. Washington has actively targeted long-standing trade relationships, prioritizing domestic protection over international continuity. Historically, U.S.-India commerce has been heavy with friction. American exporters have long pointed to severe non-tariff barriers, specifically complex local regulations and bureaucratic hurdles, as major roadblocks to entering the Indian market. But instead of matching Washington's protectionism, New Delhi is pivoting. An Indian delegation is currently advancing a massive bilateral trade agreement with the U.S. to fill the geopolitical vacuum left by other Asian economies. By moving aggressively during a period of broad regional uncertainty, India is attempting to turn short-term global chaos into a durable strategic edge. The groundwork Commerce Minister Piyush Goyal and U.S. Trade Representative Jamieson Greer held critical sideline negotiations at the WTO Ministerial Conference in Cameroon to lock in the economic strategies. Now, a high-level Indian delegation is scheduled to arrive in Washington, D.C. this month. Their directive is to bridge the February framework into a legally binding conclusion. The operational infrastructure is already rolling out. Last week, Foreign Secretary Vikram Misri launched the India-USA Trade Facilitation Portal, a direct institutional channel connecting Indian exporters with American importers. Engaging across New Delhi, Cameroon, and Washington almost simultaneously proves both administrations are pushing to execute this deal immediately. To survive the current protectionist climate, the agreement relies on a mechanism known as structured reciprocity. This requires explicitly balanced, quantifiable financial concessions from both sides. This chart shows the primary concession offered by the United States. We see import tariffs on Indian goods dropping sharply from a peak of 50% down to a new baseline of 18%. Indian pharmaceutical manufacturers are positioned to see immediate margin improvements from this tax reduction. Beyond medicine, heavy engineering firms and the textile industry will also gain substantial leverage as their export costs drop. This map visualizes the Indian side of the ledger. New Delhi has committed to deploying $500 billion into the U.S. economy over 5 years. Alongside that capital injection, the Indian government will dismantle the precise non-tariff barriers that previously kept American businesses out. The exchange of a 32% tariff cut for a $500 billion investment creates one of the largest sovereign-directed capital deployment programs currently operating. Finalizing these terms will forcefully redirect capital across the continent. With Indian goods suddenly cheaper in the U.S., regional supply chains will naturally reorient toward the subcontinent. Other emerging markets are paying close attention to this negotiation. Large economies across Africa, facing the same volatile trade conditions, are actively studying New Delhi's strategy. This agreement highlights a developing model for international trade. For emerging markets, the terms are becoming clear. Securing durable access to the American market is increasingly tied to a quantifiable exchange of large-scale, sovereign-directed investment back into the United States. Whether the April delegation secures a signed agreement or requires further rounds of talks, the resulting decision will dictate capital flows and market confidence for the remainder of the year. By offering structured reciprocity instead of resistance, India has mapped out the required survival tactics for bilateral diplomacy going forward.